Modern finance operates in a state of perpetual chaos. Fortunes are made and lost by high-frequency trading algorithms, executing complex mathematical formulas in microseconds. Financial broadcast networks feed directly into this anxiety. They fill the airwaves with flashing red numbers, urgent market updates, and panels of experts demanding that viewers react immediately to the morning's news cycle. But 1,000 miles away from Wall Street, the most successful investor in modern history operates in near silence. Warren Buffett dominates a high-speed, hyper-competitive industry by ignoring the monitors entirely. Instead, he spends his days sitting in a quiet office reading paper reports. His approach stems from a strict definition of what he is actually purchasing. When he buys a stock, he refuses to view it as a bouncing line on a chart. He views it as fractional ownership in a breathing, operational business. To find those businesses, he sifts through thousands of publicly traded companies using a ruthlessly simple 4-step logical process. It acts as a cognitive filter, designed specifically to eliminate distractions. The top layer is his circle of competence. He eliminates any business he cannot understand. Companies relying on unpredictable technology are discarded entirely. Survivors drop to the second layer, the economic moat. Every profitable business is a castle that competitors will inevitably attack. Buffett looks for specific structural defenses that protect those profits. That could be high switching costs, a legal monopoly granted by patents, or extreme brand loyalty. This massive Coca-Cola billboard dominating the San Francisco skyline represents an impenetrable moat. Decades of brand loyalty actively prevents competitors from stealing market share. By the time a company passes these first 2 steps, Buffett hasn't even looked at the stock price. He has secured extreme structural safety simply by identifying exactly what to avoid. The third layer tightens the filter around management. A great castle needs competent guards. Buffett evaluates whether executives act like rational owners or if they behave like temporary employees looking to collect a salary. He looks closely at capital allocation. Consider the approach of executives like Tim Cook here on stage. Elite managers deploy their cash to maximize value for the shareholders rather than wasting it on vanity acquisitions. Finally, remaining companies hit the bottom layer. A perfect business is rejected if the price is wrong. He calculates its intrinsic value. Then he waits for market panics to drive the temporary stock price drastically below that intrinsic value. Money is deployed only when these specific conditions align. A highly durable business must intersect with a temporary market crisis, creating an undeniable mathematical advantage. Once a company successfully navigates all 4 layers of that logical filter, Buffett executes his most difficult move. He does absolutely nothing. He holds the position. The true engine of his wealth generation is allowing compound interest to work uninterrupted over decades, letting the business slowly reinvest its own profits year after year. Compare that quiet, multi-decade growth to the short-term anxiety of this blurred stock ticker. The average speculator exhausts themselves trying to guess daily price movements. The calculations Buffett uses to value these companies are built on basic middle school arithmetic. His actual competitive advantage is his psychological temperament. Financial success at this scale requires accepting a quiet truth. It requires the discipline to apply a strict logical filter and the patience to outweight the market rather than